and welcome to the opening keynote session at the Euromoney Global Borrowers and Bond Investors Forum. It's our 30th birthday, and whilst we can't celebrate in real life quite yet, I'm delighted to be joined by Blythe Masters to kick off our 30th forum, which is obviously our virtual forum. Welcome, Blythe, and thank you very much for joining us. Where are you zooming in from today?
Hi, Victoria. I'm in Wellington, Florida, where summer has begun. It is hot and humid.
It's not bad in London, so at least our summer has also begun here. So thank you, Blythe. Blythe's bio is on the platform, but I'm going to give you a quick recap of her very impressive CV. So Blythe worked for JP Morgan for 27 years, where she was a member of the Corporate and Investment Bank Operating Committee and Firm-wide Executive Committee. Her positions included Head of Global Commodities, I think that's when we met in Saudi, Head of Corporate and Investment Bank Regulatory Affairs, Chief Financial Officer of the Investment Bank, Head of Global Credit Portfolio and Credit Policy and Strategy, and Head of Structured Credit. She moved on to become Chief Executive Officer of Digital Assets, the leading enterprise blockchain fintech company. And today, Blythe is an industry partner at the fintech specialized private equity firm, Motive Partners, where she is also Chief Executive Officer of Motive Capital Corp. Very impressive CV. So we're going to come on to talk about Motive Partners and fintech in due course. But let's start by talking about our old friend, the Great Financial Crisis and credit default swaps. So you, Blythe, you were quoted in the British press as saying that credit default swaps have been miscast, much as bad workmen tend to blame their tools. Subsequent events have vindicated your viewpoint, with CDS now being mainstream. Do you think that the CDS market is now in an appropriate regulatory framework to address the risks that some commentators ascribed to it?
Well, it might not entirely surprise you to hear that quote was slightly taken out of context. The context being at the time a debate as to whether, because of the very significant role that credit derivatives did play as a risk transmission mechanism during the global financial crisis, should they, and indeed other forms of derivatives, essentially be banned or outlawed. And it was in response to that that I made the comment that the issue with the way that derivatives played a role in the global financial crisis wasn't necessarily inherently because of the nature of the product. It was rather due to the way in which the product had been used, and more specifically, inappropriately risk managed.
Yeah.
And the subsequent regulatory reforms that took place in the aftermath of the crisis, which obviously started in the US with Dodd-Frank, but had companion regulation almost throughout the rest of the world, did many things to address some of the identified risks and contagion risks associated with derivatives activity. So mandating the central execution of liquid swaps, mandating central clearing for a substantial majority of derivative activity, mandating trade reporting, and so on, were all very important reforms. More importantly, I think, were the reforms that led to a significant decline in leverage by the major users of derivatives, those being the big banks. And that decline in leverage happened as a result of a raft of different regulatory capital requirements that actually, in some respects, may have added up to being too much.
Yeah.
They may have curtailed some otherwise economically beneficial activity, but that's a topic for another day. The question really is, or your question was, is there sufficient regulation now around CDS and more broadly? I would say there's one glaring gap that concerns me somewhat, and certainly there's been a fair amount of commentary about this, both from users of the products and others, and that is in the process of mandating central clearing of derivatives, including certain credit derivatives. There has been a concentration of risk, operational and credit risk, with central CCPs, clearing counterparties, that themselves have now essentially become potential sources of systemic risk. And it's very important that there be sufficient resiliency and supervision of those entities, and that there be sufficient skin in the game by the owner operators of those entities, particularly in light of the fact that they now enjoy a mandated requirement to use them. And in the absence of that, there remains potentially significant and even worse systemic risk consequence associated with having concentrated so much derivative activity through such centralized, so few and such centralized entities. So I would keep your eye open for commentary on that. There's been some recently, and there will be more in the months to come, because I believe that's an important part of unfinished business in the reform of derivative products broadly, not just credit derivatives.
And who's going to drive that change? You know, whose responsibility is it to make sure that gap is filled?
Well, that's actually a very good question, and the answer always depends on the jurisdiction in question. And then, of course, it always further depends on the degree of and ability of regulators to coordinate across borders.
Yeah.
And both of those things have varying degrees of challenges depending on what products you're talking about and which jurisdictions you're talking about. The challenge in the United States is that regulation remains highly fragmented. By contrast to the UK, where you have essentially one authority who oversees all financial supervision, enforcement, and systemic risk consequences. In the US, that's a highly distributed responsibility across multiple different agencies. And so the challenge of establishing, who has ultimate responsibility for systemic risk issues as opposed to narrower specific market conduct issues or individual prudential issues at the level of an individual entity remains unaddressed or not completely resolved, certainly in the United States. So there are a number of forums that global regulators use to coordinate their activities and their responses. But even within a jurisdiction as enormous and as important as the United States, you don't have one single clear answer as to who is responsible overall for the systemic consequences of many things, actually, not just derivatives. So that too is an area for, I think, potential recommendation for improvements.
Yeah.
If you pick one entity which has the depth of experience, has the knowledge and resolution capabilities, the credit experience, as well as prudential responsibility for some of the larger actors, it would be the Federal Reserve. And perhaps strengthening the supervisory responsibility of the Federal Reserve across the different agencies that oversee the individual clearing agencies, for example, clearing entities, might be a good recommendation.
So watch this space. Let's hope that gap gets filled. Yeah,
I think it's unfinished business, and I think that it is not something that is lost on the world's regulators, nor indeed market practitioners. And I think actually some of the fault lines in the financial system that we all knew still existed after the reforms post 2008 were only brought into relief and made even clearer because of the events of last year during the COVID crisis.
Let's come on to talk about blockchain. You're a champion of blockchain. It's in particular in its application in the infrastructure financial services sector. But detractors might argue that it's just a better database that will save a few costs in the back office and isn't a big deal. What would your response be to those detractors?
Look, I think that The challenge with conversations about blockchain is they often devolve into matters of religion, philosophy, and principle. And when you get into that territory, as you know, we're not particularly good at compromise and listening to each other. I see blockchain as a technology that has all sorts of interesting applications and implications. And as you mentioned, one that I've been closely involved with and associated with is the potential for application to the monolithic infrastructures that exist in financial services that have existed for decades and that are responsible for things like the fact that even though we have self-driving cars on the roads, we're still not able to clear the majority of equity securities in less than 2 full days, which is, a comparison that is just still astonishing to me. But the reality is, though, it's not just about the technology that creates that limitation. There's a lot that goes on in those 2 days between trade date and settlement date that has to do with interventions, many of them manual, by many entities in the ecosystem that play a role, from custody to settlement to clearing to the brokers to the clearing members to the ultimate buyers and sellers. The reality is that what blockchain offers in that context is an enormous opportunity to simplify the post-trade space by effectively creating the opportunity for a shared golden source reference database of position and transaction activity that is immutable, that is self-auditing, and accurate by design, and where multiple independent parties have the ability to authenticate and depend upon that single record, and therefore eliminate the need for reconciliation and the maintenance of hundreds, if not thousands, of distinct records of the same information, which of course then get out of sync and aren't stored in the same manner and are subject to error and all the effort that goes into reconciling those things. The question is, why then, if the benefits are so obvious, why has this not taken on more quickly? Yeah. And the answer to that has to do with 2 things. One is the sheer burden of the legacy infrastructure, the sunk costs there, and the enormous cost associated with change. And the second is the need to build up a network effect around a movement for change that is sufficiently great and has enough momentum to make it worthwhile for parties to undertake that cost of change, because if enough of them get on board with a new approach, then the benefits will accrue, because they will be able to dismantle the old infrastructure and replace it with the new. Many blockchain projects today are supplements to the status quo. They're not replacements to the status quo. So it's not a coincidence that one of the world's most exciting and forward-looking projects in this space is happening in Australia, where you know that the ASX, the Australian Securities Exchange, is replacing the entire post-trade infrastructure for clearing and settlement of cash equities with a blockchain-based system. It is the only provider of that technology in that marketplace. And as such, it has the opportunity to provide to all participants simultaneously a new infrastructure that, if participants choose to take a node, will enable them to obviate the need for reconciliation. And if they don't, then they can continue to interact using the old-fashioned messaging-based communication that they've used with the old infrastructure. So they've got a solution for all parties, including those that are smaller and more averse to change. That's a great example of an ecosystem which is sufficiently closed, and where there's no fragmentation, where it makes economic sense for a full replacement of the old world infrastructure. The benefits of blockchain will be deployed in enterprise financial services through time, and it will continue to take longer than you thought it would. and when it happens, it'll happen more quickly than you thought it could. And that's the nature of these things. But there are a number of quite interesting projects around the world, and notably, I thought it was fascinating that in the context of the retail investment phenomenon, the meme stocks, the GameStop stop challenges this year, with the clearing brokers having to shut down their customers' ability to trade because of having insufficient collateral with the central clearing agencies, I thought it was very notable that DTCC, the world's biggest fintech, that clears 1.5 quadrillion notional of securities in a year, that's I think 15 zeros or something like that, put forth a white paper on what would it take to get from T+2 to less, all the way down to T+, 1 or 0.5 or even 0. They point out that a lot of the challenges there will be operational change management, but the technology that they would lean on to do that would be blockchain based, and they indeed have a project that is exploring that. And of course, the motivation there is to actually reduce risk in the system, because if you reduce the time it takes to settle securities, the amount of collateral that is need to be put up by participants against the risk of failure during that window between trade and settlement date declines rapidly, and it declines with the square root of time. So it's exponentially beneficial to get that to happen. So lots of talk about this, and I think this also is an area where you should expect to see change in the years to come.
It's not a matter of it's a matter of when. It's just it will happen. But I mean, one of the things when people talk about the slow adoption of blockchain is they think it's a reluctance of regulators. Do you think there is any reluctance on their part?
No, I think that's unfair. I mean, I think there was appropriate skepticism and concern about blockchain in all its different facets, and blockchain is such a big topic. So cryptocurrency is one obvious use case that arises out of blockchain. Clearing infrastructure, settlement infrastructure is a totally different story. Yeah. There are reasons for a regulator to be cautious about both. Cryptocurrency raises all sorts of issues associated with that by and large are progressively being addressed. But initially, with anonymous, non-trackable transactions, KYC, AML concerns, consumer protection concerns, the risk associated with loss of private keys, all of these sorts of things, regulators have warned about appropriately. So they haven't warned generally, they haven't banned the notions of these new modern technologies. They've just expressed caution, and also expressed strongly the need to ensure that the same standards of protection and regulation exist in all corners of the market, which I think seems reasonable. That's also true with their thinking on blockchain-based market infrastructures. If you're going to operate a market infrastructure, there is a big raft of principles for operating those that regulators globally and in coordination have put forth. And you're going to need to abide by those. It doesn't mean that you can't deliver the benefits of the technology while still abiding by those. So I think I think generally speaking, the regulatory response has been not unreasonable. There are some areas where it's been poorly coordinated, and some areas where it's been something of a knee-jerk reaction, potentially with unintended consequences, from a tax point of view or from accounting point of view. But I think by and large, regulators are of the opinion, at least those that I speak with, that there's a lot of promise in the technology. It offers the ability to reduce risk in the system if properly implemented, by reducing settlement intervals, for example, improve resiliency by having a more distributed node-based network rather than entirely centralized systems. It offers actually, in many cases, higher degrees of transparency and ability for regulators to track activity than the rather obfuscated old world of omnibus accounts and other things that are really hard to decipher and disaggregate. So there are many benefits, and obviously the last thing that regulators are quite focused on is the opportunity for financial inclusion that's offered by these cases.
Yeah, brilliant. I want to come on to talk briefly about gender diversity in financial services. It comes up more and more in our conferences. There are many tools to address it: targeted internships, mentoring, KPIs, changing work practices. As one of the first women in a very senior role in Wall Street, which tools do you think work best?
I think no tools work if you don't have the right tone at the top, and that the instances that I've come across where real progress has been made, it's very often being driven by a leader at the top of an organization, male or female, diverse or not, that is passionate about the subject and makes it clear in everything that he or she does that this is a priority for the organization. When you talk about culture within organizations, perhaps one way to define that term is to think about it as being the behavior that people will naturally engage in when they don't think that someone's looking,
watching. Yeah.
Right. And when people in an organization know that if you ask the CEO and the CEO's lieutenants and their lieutenants, what matters to the organization, they all know the answer to that question. You may not like the answer, but you'll hear people talk about fortress balance sheet and risk issues. You'll hear some organizations will talk about talent and diversity and inclusion, and others will talk incessantly about profits and excellence and nothing else.
Yeah.
So I think that tone at the top is, if you perhaps that is a tool, but there's certainly no amount of tools will make up for the lack of authenticity in the passion and the drive for results that's coming from the top. Yeah. I think the other thing that is very important and is illustrated by a couple of studies that I've seen that look at the way in which in business settings, financial services in particular, provide feedback as part of the ongoing performance evaluation and employee development program. There have been some experiments done where machine learning and AI is used to pass through databases of written performance reviews, which are anonymized as to the gender of the recipient and of the author. And all words like his and her and she and he are removed. And then a machine is asked to analyze the information, and it is possible for those programs to detect with an extraordinarily high degree of accuracy whether the recipient of the information is male or female, irrespective of the fact that all the gender specific been removed. And actually it's to a less degree of accuracy, but to a high degree of accuracy, also possible to detect whether the author is male or female. It's not such a strong bias, but it's there. What that tells you, just there, without any opinion, just a machine and just a computer, that there are detectably different patterns in the manner in which feedback is given. Yeah. And what that probably tells you is that it's not just that people choose different words when they're speaking to and providing feedback to men and women, but they potentially value the same behaviors differently. If you assume that the behaviors are reasonably evenly distributed by sex or by gender, what you're probably discovering is that the same behaviors in a man are observed, commented on, rewarded, or discouraged differently than they are in a woman. Yeah. When I first started reading about that, I thought that was an incredibly powerful tool for a leader or leaders to evaluate all of the micro inequities that are afoot in their organization at these very crucial moments where people are being given encouragement or discouragement or direction around their careers. And if you think about it, the most valuable feedback that you get in work life tends to be that which is delivered in real time, spontaneously, and very often informally. And also quite often it'll happen on the golf course, in the bar, in the men's room, and unfortunately, given the statistics, it is in the men's room rather than the ladies' room, because 80 to 90% of the decision makers in financial services are male. So they're not having conversations with their female colleagues in the men's room. And if you think that you can detect with computers that in the self-conscious,
very carefully managed,
knowing that HR is reading bias, then think how much additional bias there is in the informal, spontaneous, casual, but vitally important feedback that women and men receive that are so instrumental to their careers. Right. And so I've started reading about that, and I think there's something really, really big in that. Yeah. And I think it can be very eye-opening. And I think it can make people realize that despite the best of intentions, the actual outcomes as experienced by underrepresented groups can be much more different than you realize. So these tools are tools that are being made, becoming available, obviously, because of the advent of technologies, which is changing everything, including the way that we manage people. But I'm reasonably excited about that. By the way, there's a ton of similar analysis that's been done around other things like coding and scientific papers and other things where peer reviews occur, and where gender disclosing names are modified or indeed changed to be sounding like they're male, even though they're female, type of thing. Right. You get changes to the peer-reviewed results. So there's a lot of information to be had in all of that, and I think
fascinating.
Really interesting.
Yeah, I've got a final question for you, Blythe, because we're running out of time. I want to talk about Motive Partners. So Motive Partners, private equity firm specializing in technology and financial sector. What was the narrative that persuaded you to join?
Oh, well, so first of all, I spent my whole life, almost 3 decades in financial services. I consumed a lot of financial technology and saw a lot of it there. I then spent 4 or 5 years running a fintech. And as a result of all of that, I've developed a passion for the fintech space. I find it absolutely fascinating, scary, exciting at the same time. I think we're going to see more change in the next 5 years than we saw in the last 25 years in financial services. Yeah. As a result of financial technology. More than $1 in every $4 in the world that are spent on technology are spent on financial technology, wow. Not just financial firms, but by non-financial firms too. And we have huge changes ahead of us. So Motive, because of its specialty in that space, that was the first thing that attracted me. The second is it's a young firm, began life in 2017 or so. So it's still a firm that is a small intimate place to work, despite COVID and Zooms and those limitations. But most importantly, the thing that's a differentiator at this firm is the very unique operating model. And so at Motive, we're a private equity firm. So of course we have investors with financial engineering skill. We couldn't be a private equity firm. We don't. But what we also have, which is truly differentiated, is a stable of individuals like myself who are industry partners who have decades of, and it adds up to, I don't know, 200 man and woman years worth, or perhaps more now, of experience of being operators and entrepreneurs in the fintech and financial services space. And added to that is the third of our pillars, operating pillars, which is in-house technology capabilities, known as Motive Labs and Motive Create, where we work with partners in the industry on developing our own technology solutions, but more importantly, Motive Create is pervasive in everything we do. We work with all of our portfolio companies to generate value creation plans that are technology driven, and then actually, in many cases, actually execute them with and for those companies. And that combination of investing, operating, and innovating capability in-house makes financial technology investing, which is often complex and often obscure and difficult to understand, because a lot of what goes on in financial technology goes on behind the scenes and under the surface, and frankly, some of it's pretty ugly stuff. But actually knowing where the bodies are buried, knowing what a good business model and a bad one looks like, knowing what it takes to renovate a technology that's past its sell-by date, knowing what the journey to cloud really means and how to introduce APIs and microservices and build a SaaS business model, and having people in-house that have done all of those things, and not only done it, but done it serially, successfully, in many cases creating literally tens of billions of dollars of enterprise value. That's the differentiator. And so that's why I joined Motive rather than one of the other big private equity players that I knew from my background at JP Morgan and elsewhere, because I thought it was really doing something different. Yeah. And in fact, now having been here for 18 months and having watched the firm as many successes, including some of the really iconic transactions that it's pulled off, most recently with the acquisition and pulling together of 3 companies into what is now today's InvestCloud, one of the first end-to-end wealth tech platforms in the world that has more than $4 trillion of assets under management flowing through its pipes, and that connects investment distributors, so wealth advisors, private banks, RIAs, IFAs, all around the world, hundreds of thousands of them, with the wealth manufacturers, the investment managers. A 3-year journey that it took us to pull that together, and a big multi-billion-dollar consortium of investors at the end. That was, example of something that was thesis-driven, couldn't have been done by a firm that didn't have the domain knowledge that we have, and that was really exciting. And that's just one of the many really groundbreaking transactions that Motive has pulled off in recent times.
Sounds incredibly exciting. So I'm sure you'll enjoy it. Blythe, I'm going to have to wrap it up. We've gone over time. Thank you so much for joining us today. It's been a real pleasure to talk to you. Thank you to the audience for watching. We've got lots of great speakers coming up, so stay tuned, and the next session will follow shortly. Thank you, Blythe.
Thanks, Victoria.